They don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get in the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hi guys, welcome to the Real Estate Jam podcast. I'm JD with my wonderful, talented, and very busy co-host.
Hey JD, how are you?
So I'm doing all right.
Happy Monday.
Happy Monday.
Mondays are so great.
They're my favorite day of the week. You got the whole week ahead of you to make your billions.
Yes.
All right, guys. Well, I am super excited to introduce you today to Grant Reaves. He's a co-founder of Stoic Equity Partners. He's a smart guy that's going to shed a lot of insight into some of these multifamily commercial not multifamily, I'm sorry, commercial industrial projects and stuff. And we can't wait to hear what you have to say. Grant, for those in our audience who maybe don't know who you are and what you're about, can you kind of give us a rundown where you came from and where you're at now? And we'll take the conversation from there.
Yeah, for sure. Well, first off, thank you guys for having me and happy Monday as well. It's always fun to record on a busy Monday, right?
Yeah, for sure.
Appreciate y'all making the time. But yeah, as you said, my name is Grant Reaves. We own a company called Stoic Equity Partners. My business partner and I started the firm through COVID. Prior to that, we were longtime commercial real estate brokers in as well as regionally on the Panhandle in South Alabama, as well as throughout the country. I primarily sold limited service hotels. And then my business partner primarily did triple net retail deals. But we always wanted to get on the principal side, and through COVID, actually had a little bit of time there when the phone stopped ringing there for a couple of weeks to put our heads together and kind of hatch the strategy of coming up with doing some deals through Stoic. And so did our first deals in 2021. We're in the self-storage space. We had 2 self-storage deals in Fairhope, Alabama, one in Pensacola, Florida, and then one in Little Rock, Arkansas. And around that time, self-storage, especially in the Gulf Coast, was just, there's so much new inventory coming in that we kind of were looking at it and kind of having a hard time really scaling that portfolio, just kind of being newer in that asset class. And again, with a lot of new supply coming in, it was a little bit difficult to make numbers work, and then rates started rising. So we kind of needed to pivot at that time. And so one of the biggest things we always look at in real estate investing, just like any type of investing, is supply and demand. And so we wanted to go into an asset class that was maybe low supply, and maybe down a ton of new product coming on. And we ended up in multi-tenant flex industrial, which is what we do. It's 90% of our portfolio. That's all we do now. But what that is a say 50 to 100,000 square foot building made up of maybe 10 to 20 office warehouse suites. So maybe 3,000 square feet up to 9,000 square feet, maybe 30% office, the rest warehouse. These are located in business parks throughout the Southeast. But yeah, that is what we do. We buy those that have low market rents or maybe are low occupancy, do some renovations, clean up the properties a little bit, and be able to mark the rents to market and be able to add value by doing so. We work throughout the Southeast, primarily in secondary cities. So more like Birmingham, Alabama, Memphis, Tennessee, Little Rock, Arkansas. We don't really play in like the South Floridas or the Austin, Texas, or Dallas. Like we like a little bit of the kind of slower, more stabilized markets. Just feel like you can get a little bit better yield going in. But yeah, really high level. That's what we did. And so we currently own about 100 million in assets, about 1 million square feet. And again, about 90% of that is all flex industrial.
So is your strategy to, like the BRRRR method for house flippers or rental, but on these industrial complexes, is that what you're doing? You're going in and fixing them up, holding them in your portfolio, or are you going in and flipping them? What is the actual strategy?
Yeah. So we usually hold them for about 5 years is our normal timeline. So we run funds as well as we have direct syndication. So we are raising outside capital. So anytime that you have outside capital coming into deals, it's good to have a good timeline on how long you're going to hold that asset. So kind of our typical deal is we're going to go in, we're going to buy the asset we'll bring in some of the equity. We're going to raise 95% of the equity from LPs. And we'll buy the asset. We'll begin our value add strategy, distribute some cash flows those first couple of years. But really years 3, 4, and 5, we'll be able to distribute pretty high cash on cash returns. And then we'll sell the asset at the end of that 5-year kind of term. So you have, enough of a cash flow play as well as an overall IRR play at the same time. So it's not really just one or the other. We're not like fix and flip. We're also not like long-term hold, kind of more medium strategy.
Sure. Well, I know that the interest rates are going to be affecting you guys too. So how are you identifying these off-market distressed or even on-market distressed properties that work once you put a bunch of money into raising the rents or just the value add, and then still able to yield a profitable cash flowing real estate deal?
Asset, yeah, for sure. And so obviously, just like anything, you have to be able to find something that has enough yield. If you're debt, we're signing a lot of debt in the 8.5% range. We do fix all of our debt, so that's been nice. We didn't really have any problems coming through the end of COVID where there were some issues with people that were floating a lot of stuff and got kind of caught in the wrong end of that trade. But we just got to find deals that have enough beat on them. We're mainly buying off market, but through brokers. We have a really good broker network throughout the Southeast that kind of know what we like to buy, understand our strategy, and are able to identify and bring us the type of deals that we like. We usually buy from more legacy owners, so a lot of guys that maybe are groups that have owned these properties since early 2000s or even 90s that their basis in it is so low because it's probably 1999 pricing, or they built it in 1999, that their rents might be $5 a foot. Market's currently 12, but they're sitting there going, well, I'm cash flowing pretty well, so I'm just gonna keep it going. But that's a great opportunity for us to go in there, buy it at the valuation based on their $5 rents, and be able to really push rent. We did that recently at a deal in McDonough, Georgia, which is south of Atlanta, about 30, 45 minutes. But it was 90,000 feet. Guys who built it in the late 90s still owned it. They were getting ready to retire and kind of get into that age. And so we bought the property, again, $5 rents in place, and we're signing renewals at $12.50. So we're taking them over 2 times.
Sure.
So yeah, just things like that. It's amazing. But it's about just obviously having an edge and understanding what you're looking at and knowing where you can push and where you can't, and also how much it's going to cost to get there on the renovation side.
Right. So what is the criteria that you're shooting for? What are you looking for? And then tell me a little bit about what your process is for determining, how to best increase the value.
Certainly. So our typical buy box is a 50 to 150,000 square foot building or portfolio of buildings in a certain market. We want to be in kind of the growing area of a market. So like, for instance, Jackson, Mississippi as an MSA is not necessarily growing on a population basis, but there are little areas within that MSA that have new retail coming in, new multifamily coming in. That's where we want to be. Wherever the new growth is, the kind of more affluent area, that's where we want to be investing, right? And so that's one of the first things we look at. Then we're mainly looking at what are in-place rents, what are market rents, and what renovations need to be able to get done to get there. So we have an analyst in-house that runs our models to start with. I oversee that department as well. And so that's one of the biggest things, because some of the properties we look at, we have to tear out a lot of office space, which is kind of our heavier value add kind of renovation. But a lot of times it's maybe a new roof, reseal, restripe the parking lot, repaint the exteriors, do a little bit of the carpet and paint on the interiors, but it's not a ton of heavy lift. You talk to value add multifamily and they're redoing kitchens, redoing bathrooms. It's very expensive. We are primarily just coming in, putting down some cheaper LVT flooring, fresh coat of paint on the walls, and cleaning it up a little bit. And we're able to get to market by doing that. On that renovation piece that I talked about, tearing out office, that is one thing that we have started to do coming out of COVID. Obviously, office is not nearly as desirable as it used to be. And so some of these flex parks in, say, 2010, early 2000s, they would get built out as maybe like 90% office. And so you might have a 10,000 square foot suite that's almost completely office, because you could rent that for a lot more back in the day. Obviously, now that is not the case. And so we're buying some complexes that have really high vacancy. Because of that, all their vacant units will have high office build out. So we'll go in there, demo out the office, turn it back into maybe like 50-50 office warehouse, and be able to really increase the occupancy by doing that. So that's been another really good strategy that we've been able to do. Yeah.
Yeah.
And it's a lot cheaper to pull stuff out than add stuff in. So we like that a lot. Demolition's a little bit cheaper.
Yeah, definitely. Well, when you're running your numbers, do you have a certain, like, do you know that you need to increase the rents by 102%, or what is it that you're that strikes you as, oh, hey, this might be a good deal, something that we need to look at better? How much, what's, so you said you went
Yeah, how do
from
we look at
5 to
that?
12, so that seems like a pretty good deal, but what are you typically seeing, and what sparks your interest?
Yeah. And so the biggest thing that we look at, I mean, obviously on the commercial real estate side, cap rates are a big deal on what you're buying at an in-place cash flow. We usually buy off a yield on cost. So it's a forward-looking cap rate, right? So like say year 2 yield on cost. So we usually want that to be somewhere about 400 basis points higher than where our debt is. So like today, we like to see around a 12 yield on cost. Some of heavier value add deal will be really good yield. We will go lower than that on more stabilized deals. I mean, we do have some life insurance companies we're getting debt on currently in the high 5s, low 6s kind of range. And so, you can get a little bit more compressed on that yield on cost, but it's a little bit more cash flow, right? So that's really the basis of what we're looking at. And then also just kind of what is the LP net IRR? What are we paying our investors on the back end is really the biggest thing. I mean, we're typical value add commercial real estate. We need to be in the high teens on the back end, net to our investors. And so that's the main thing we're shooting for. But there are a couple of different levers that we have to look at, because I mean, a deal that maybe is a little bit more stabilized, you're not pushing rents as high, but you're getting good at in-place yield on the front end, that's going to be a deal that's a little bit more cash flow heavy. So you might be, I'm just using an example here, it might be like an 8% cash on cash average throughout the life of it with a 13, 14 IRR, versus that deal in McDonough I was talking about. It's like a 20 plus IRR, but your cash on cash is going to be 4, because it's going to take a lot longer to be able to roll leases. Because that is one thing we deal with in our world. Self-storage or multifamily or even single family, you usually can turn rents yearly, if not sooner than that. Like self-storage, you can turn monthly, right? These are usually 3 to 5 year leases. So that's something we always have to look at is how long is those leases out there, because you can buy a deal that has really low leases and a lot of room to be able to push rent. But if there's 4 years left on all the leases, you're going to have to sit there and negatively cash flow for 4 years. That doesn't make any sense. So that's a big thing we have to look at as well.
Yeah, absolutely. And so you, in the beginning of the call, you had mentioned that you're running syndications and you also have a fund. Can we talk a little bit about both of those? Like your syndication, Are you only using accredited investors, or what kind of syndication are you running, and what's that look like?
Yeah. So we only do accredited investors. We usually do $50,000 share sizes. So starting out, we did more friends and family, just like most people do, and raising from past clients. Jeremy and I obviously were in commercial real estate brokers for a long time. So we'd had a decent Rolodex of people that we like to invest in commercial real estate already. So it was obviously very helpful. We then moved on. We have some family offices that invest with us, as well as some larger institutional investors that want to come in on some larger deals that we do. So that's all gone really well. And so we have a very diverse investor group, everyone from maybe has $150,000 investor to investment with us to, we have one group that has $7.5 million with us. And so it kind of varies throughout that. On the fund side, we do have one small fund that has about $7.5 million in it. We've deployed all of that 7.5 and probably will look to close out that fund here pretty soon, and probably look to start raising on the next one. What we kind of like to do there is have a fund that's able to get somebody that maybe wants some diversification, wants to only invest, say, $50,000, $100,000, $150,000, but wants to own that over multiple properties. And then we'll bring in maybe a larger institution to make up a good equity chunk. So for instance, like we're $1 million deal, total equity needs $4 million. We'd like to be able to have a fund maybe make up $1.5 million of that, and then an institutional capital partner make up the other $2.5 million. It's kind of a good way to blend it all together.
So when you're speaking specifically of the fund, are you identifying the property, creating the fund, or are you creating a fund and then going out and finding the property?
On the syndication side, we find the property, then raise the money. On the fund side, you raise the money, then find the property. So it's a little bit of both. So on the syndication side, we're definitely raising money after identifying, putting property under contract, going through most of the due diligence, and then raising the funds. But on an actual fund itself, it's usually raised on the front end, then deployed.
Sure.
Which obviously makes our lives a little bit easier, but some investors, prefer to see the property first. So it's good to be able to do both.
Yeah. Well,
for sure.
One of the sticking points that I've heard other people concerned with is that sometimes, let me ask it this way. how do you ensure that you're not put in a situation where you pick up a deal that's maybe not the best so that you can deploy the fund, instead of like the syndication, you identify the property, you get the money. Now you have the money, that juice is running. It's costing you guys money to hold that fund. Do you ever feel pressured into a deal that maybe you should have passed on?
Yeah, I mean, fortunately, we've only done one small fund, and we deployed those funds. I mean, we had those properties as we were raising that money. We actually had those properties in the pipeline, so that didn't really have an issue. There's three larger properties that we put into that fund. But I mean, that is the downside of a fund, right? Like, it's a lot more. Hey, what is the sponsor's track record? What is their trustability? How much do I trust them? How much do I know people that have invested with them? What does their reporting look like? How well do they run their shop? And then also, what is the actual strategy, right? Because in a fund, you're really investing in a strategy. In syndication, you're investing in a property, which is also a strategy, but you know what I mean? Like, it's a lot more direct. Like, a fundraise is a lot more like, hey, this is what we're going to go do. This is what we buy. We buy multi-tenant flex. This is where we're going to buy the Southeast. But I mean, syndication is obviously like, we're buying this building in Little Rock, Arkansas. It's at 123 Main Street, period. So yeah, I mean, I think it's just for the people investing, you really need to do your due diligence on your sponsors and see what their other funds look like, see what their other just deals in general look like. So, because you're really trusting that manager on a little bit more of a blind pool for sure.
Yeah.
Obviously, the fund model is a little bit easier on the sponsorship side for us, just because whenever you're raising capital deal by deal, it is a little bit more of a it's hard enough to buy a property within a 90-day period. It's a lot harder to buy a property, do your due diligence, and raise all the funds, and then put together a security offering. It gets very complicated timeline wise. But it's good. Like I said, we kind of are doing both until we can kind of pick one run to go at, because there are people out there that really want to get into the weeds, really understand exactly what they're investing in. But frankly, there's other people that don't want to get that far down into it. They're just like, hey, I like your strategy. We trust you guys. This is, y'all go do it. So yeah, each investor is a little bit different, but that is definitely a real concern to have.
So pros and cons for you guys is it's like having a checkbook. You can just, when you identify the property, cut the check, you're into it. You don't have to worry about getting the money. The cons are, if you don't find a property, you're still responsible to those investors. On the syndication side, there's a lot more work and a lot more stuff that you have to do within that contract period to make sure that you're executing it the right way.
Yeah. And sometimes on the syndication side, you have to look at even bridging deals. Like right now, we have a deal that we just bought last week in Tallahassee, Florida. We've raised about half the equity. We brought in and put in bridge the rest of the equity for right now. And then we'll continue to raise it after closing. So that's some other ways that are able to help out the syndication world. And a little bit of that is just being able to have the size to be able to do that as we continue to grow and progress. So like, that is a nice thing though, as well, to be able to buy properties while you continue to raise on the syndication side, because like that deal, we're signing new leases so we can show a new track record. So it's like, hey, here's the business plan, and we're already proving it out every year. So it's a nice way to be able to raise capital. And also there's no, execution risk from the investor side, right? Because that is a big thing. It's like the year about $100,000 that's going to go into XYZ deal, and that deal blows up at the end, as we've all seen deals do. Then you have to go replace that money somewhere. But in this, it's like, hey, the deal's ready for you to go, and as soon as you wire your money, it's invested. So
that's it. Mm-hmm. That's great. So what is your guys's plan? Where are you heading? Where are you taking? Are you trying to own $20 billion in real estate? Are you content with where you're at? Where do you think you're taking Stoic Equity Partners here in the future?
Yeah. So we're currently at about 100 million AUM. We want to be at $1 billion within the next, call it 6-7 years. So we're continuing to grow. We're going to do that by continuing to do multi-tenant flex acquisitions. We do think eventually, like our biggest thing with flex industrial is the fact that in most markets, you cannot build this product and be able to make the numbers work because the rents are just frankly too low in most markets. But I do think that'll change eventually. There's so much demand in that asset class. Vacancy so low. Rents are continuing to rise because of that eventually the numbers will start to make sense where you can build a new product. So we would like to be able to go and have a portfolio a few million square feet of flex in our portfolio as soon as like the building starts happening, because that will really be able to push rents throughout the entire market. And then we'd like to start building as well. So we're already starting to look at that on the Gulf Coast a little bit. You guys are right down the road from us, but I mean, the whole I-10 corridor, there's not any of this product available to anyone, and everyone needs it. I mean, everybody in our world talks about it constantly. So I've identified a few sites that we would like to start. We'd like to get on the front end of that, because I do think that a lot of building will come into the space in the next, call it 5 years, 10 years. And we'd like to be on the front end of that as well while we're continuing to buy.
Yeah. Well, what does your team look like right now, and how is it operating? And then what are you going to need to do to the team to get to the $1 billion under management?
Yeah. And so we have a total of 8 people here. So we have Jeremy and myself run the firm, and we're the co-founders. And then we have Matt, who's an in-house asset manager. So we use all third-party property managers. So we're using commercial real estate firms like just trying to think of a random word. Jackson, Mississippi, we use NAI, local affiliate, does a really good job on the flex industrial management side. So we use those guys there. And so we have in-house asset managers working week in, week out with those leasing agents, with those property managers to kind of stay on top of that. We then have an in-house controller. And then on the acquisition side, we have an analyst that handles a lot of those broker relationships, deal flow, underwriting, and that works directly with me. We then also have a project manager who handles the construction side of things, as we're trying to chase more new construction, and a transactional manager that works really, really closely with that project manager. Just because obviously as you transition into development, we've done some development. And so we know from the past, you got to have a really dedicated team that's really focused on that, because it's a lot of work that goes into developing assets for sure.
And as you expand, do you plan on bringing any of those functions in-house? Do you plan on expanding the team, or do you think that, your 8 core people can take you to where you want to go?
Yeah, I think we will. I mean, obviously, as you get larger, you'll have to have more controllers. You'll have to have more asset managers are the biggest pieces, petition more project managers. But I mean, like Matt, that is our asset manager. He's managing 1 million square feet. I'm trying to think how many tenants that is, 100-ish tenants, something like that. And they all have differentiating, terms. Then you have 15 different insurance policies you're dealing with. There's just a lot of moving parts on the asset management side, which then also ties in really closely with the controller side. So like those are the 2 avenues where we will end up having to have more asset managers, more in-house accountants, just to handle that volume. But we do have a really great team that's very core, that's been here really since we got started. For the most part. So it's been really nice to kind of grow with them. Everyone really understands what we do, why we do it. And I mean, that's one of the biggest things that you need for a good, well-oiled machine, right? To be able to really scale is a bunch of people on the same page, rowing in the same direction.
Sure.
So
yeah, that's great. Okay. And so a lot of our listeners tend to be beginning mid-level investors. And when we're talking about $1 billion, when we're talking about 50 million, all of these numbers seem really far out there, really far away. What does your regular investor need to do to start moving towards being able to invest like you guys are? It doesn't happen overnight.
I think that's kind of. Yeah, I mean, it definitely doesn't happen overnight, but I mean, it kind of can. I mean, if you have someone who's maybe a mid-level investor who's invested and done, BRR method or does some fix and flips or some residential just in general, and wants to get more on the bigger numbers, the bigger deal size, that kind of stuff. I mean, that's why syndications, frankly, and passive funds are really nice to be able to get started on that. I mean, that is one of the biggest things we really like. It's like if somebody sees that really nice institutional quality asset for $15 million, but they want to be an investor in that. Well, guess what? We can, for $50,000, you can be an investor in that deal and be able to share in that strategy with us. And so that's always been my biggest thing is like, even if you do want to be a sponsor, you want to run your own deals one day, that's great. I would start off in the syndication space as a passive investor, really learn the asset by letting somebody else do the work. And then you might decide to break off and start doing it on your own, or maybe just continue on the passive side. As we sit here as sponsors on the day-to-day, it's a lot of work. So kind of jealous of the passive guys sometimes.
Sure. Absolutely.
Yeah.
Awesome. Well, if if our listeners wanted to find out more about you or what you guys are doing over there at Stoic, where can we send them? How can we get them in contact with you?
Yeah, emails are the best. So it's G Reaves. So that's GREAVES at stoicep.com. So STOICEP.com. That's the easiest way. Our website is also stoicep.com. And so you can go there. Phone numbers there, emails there. Love to get in touch with you. So whether somebody's looking to get into the syndication space, wants to understand it more, and wants to talk directly about what we do, happy to help however we can, and always like to talk shop across the board. So
awesome. Well, thank you, Grant. We really appreciate your time. Thanks for sharing with our audience.
Yeah, thank you guys for coming or for having me. It's great.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter at The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.